Markets did not wait for confirmation. They reacted immediately. Stocks hesitated, the dollar weakened, and defensive assets began to move. The trigger was not earnings, inflation data, or economic growth. It was something far more fragile: confidence in the independence of the Federal Reserve. For decades, global markets have operated on a single assumption: that monetary policy is insulated from political pressure. When that assumption is questioned, pricing changes instantly. Central banks do not move markets by force. They move markets by credibility. Credibility allows words to matter. It allows guidance to stabilize expectations without action. The Federal Reserve's power is not money creation. It is trust. When trust weakens, volatility replaces stability. Markets reacted not to what happened, but to what might happen next. Uncertainty, not outcomes, drives repricing. The Federal Reserve sits at the center of global finance. Its independence anchors currencies, bonds, equities, and capital flows. If that anchor shifts, everything connected to it must adjust. This is why markets move before clarity arrives. Independence matters because it separates long-term economic management from short-term political incentives. Politics values speed, popularity, and visibility. Monetary policy requires patience, restraint, and long horizons. When those worlds collide, markets fear distortion. History offers repeated lessons. Central banks, under political pressure, lose control faster than expected. Inflation expectations become unstable. Currency confidence erodes. Capital seeks safety elsewhere. Markets remember this. Even when investors do not, the reaction was not panic. It was recognition. Investors understood that independence is not binary. It weakens gradually, then suddenly. Even the perception of interference changes behavior. Currencies respond first because they reflect trust. The dollar weakened because confidence was questioned, not because policy changed. Gold strengthened because it benefits when institutional trust declines. Bond yields moved as investors reassessed long-term credibility risk. Equities hesitated because uncertainty raises discount rates. Nothing dramatic happened. That is precisely why the reaction mattered. Markets price risk before damage appears. This response was about second-order effects, not headlines. A credible central bank can slow inflation without crashing growth. A politicized one must choose between economic pain and political pressure. Markets fear that choice. When investors lose confidence in the referee, they stop trusting the rules, and when rules feel unstable, capital demands protection. This is why independence is valuable even when it feels abstract. It allows markets to plan. Planning reduces volatility. Volatility increases required returns. Higher required returns reduce asset values. This chain reaction explains why markets respond instantly. The Fed does not need to lose independence for damage to occur. The risk alone is enough. This is not about personalities. It is about institutional design. Strong institutions outlast individuals. Markets price systems, not statements. Once credibility is questioned, it takes time to rebuild. Confidence is slow to earn and fast to lose. That asymmetry explains the speed of the reaction. Investors did not sell everything. They adjusted margins. Risk exposure narrowed. Defensive assets gained attention. Liquidity preferences increased. This was not fear. It was discipline. Sophisticated capital responds early, not loudly. Retail investors often wait for confirmation. Markets do not. The response reflected an understanding of how fragile stability can be. Monetary systems rely on belief as much as policy. Belief cannot be forced. Once doubt enters, it spreads quietly. This is why central bank independence has always been defended aggressively. Not because it is perfect, but because alternatives are worse. Markets know this. The reaction was a reminder of how much modern finance depends on trust. When trust wavers, markets ask for compensation. That compensation appears as volatility. This moment does not guarantee crisis, but it explains why investors recalibrated immediately. Markets are forward-looking mechanisms. They price what could go wrong, not what already has. Ignoring these signals does not make them disappear. Long-term investors understand that credibility risk compounds. It does not resolve overnight. Stability returns only when confidence is restored. Until then, markets remain sensitive, not reactive, but alert. This episode is a lesson in how quickly assumptions can be challenged, and how fast markets adjust when they are. The Federal Reserve's independence is not a political issue for markets. It is a pricing input. When that input changes, so do valuations. This is why markets reacted immediately. Not because the world changed, but because the rules that govern it appeared less certain. And in finance, uncertainty is always priced first.